You are watching a system actively refusing to acknowledge its own structural failure. Right now, the financial world is entirely consumed by political theater, analyzing every facial expression of central bankers while completely ignoring the vault doors swinging open to reveal nothing but dust. Look, as of today, spot silver is trading near $80.50 per ounce. The mainstream analysts on the cable desks think this is just a simple technical rebound from a volatile February. They are wrong. What we are actually seeing is a market finally waking up to the reality of a 762.1 million ounce deficit. That is not a temporary supply chain hiccup or a minor logistics issue. That is a permanent fracture in the physical foundation of the global economy, drawn directly out of above-ground stocks with absolutely zero modern precedent. The numbers do not lie, but they are often whispered where they should be shouted. If you are someone who has spent your whole life saving only to watch the purchasing power of your hard work be eaten away by inflation, and you want to walk through what the source documents actually say rather than what the advertising-funded desks want you to believe, make sure to hit the subscribe button and give this video a thumbs up because the data I am about to show you is already in motion. We are going to look at the numbers they refuse to soften because the era of reduced stocks is no longer a future warning. It is the immediate reality. Look at the calendar. We are currently in a 5-day countdown that the cable news desks are treating as a routine political personnel story, but in monetary terms, it is the single biggest variable in the global silver complex right now. On the 29th of April, 2026, the United States Senate Banking Committee voted 13-11, along strict party lines, to advance Kevin Warsh as the next chair of the Federal Reserve. Sitting chair Jerome Powell sees his term formally end on the 15th of May. Now, you might be thinking, what does a central bank boardroom have to do with the price of physical metal? Everything. Because this is the first fully partisan banking committee vote on a Federal Reserve chair in the history of the panel. We are watching the real-time death of institutional independence. Here is the psychological trap most investors fall into. They look at the Federal Reserve and they see a thermostat, a highly precise machine where smart people dial inflation up and down to keep the room comfortable. This is a comfort illusion. The market is no longer pricing in a thermostat. The market is pricing in the institutional reality where a nominating president who has openly and aggressively campaigned on lowering interest rates by a massive margin is seating a new chair. All of this is happening while voting members of the Federal Reserve are publicly stating that inflation has actually accelerated. Silver trading above $80 is not a technical chart pattern. It is the global market explicitly stating that it no longer trusts the political will of the United States to defend the value of its own currency. The transition is no longer a future risk. It is a 5-day timeline. But the political theater is just the distraction. The true fracture is physical, and it is documented in ink. On the 15th of April, the Silver Institute and Metals Focus released the World Silver Survey 2026. They used a phrase in print that should have sent a shockwave through every trading desk on Wall Street, an era of reduced stocks. They stated, explicitly, that the cumulative silver market deficit from 2021 through 2026 now totals 762.1 million ounces. Let me contextualize that amount for you. That is equivalent to 23,715 tons of physical metal drawn directly out of above-ground stocks. It is gone. It is not sitting in a vault waiting for a higher price. It has been consumed by industry and investors, vaporized from the ledger. The deficit for 2026 alone is forecast at 46.3 million ounces, which is a 15% expansion of the deficit recorded the previous year. Now, if you learned economics from a textbook, you are probably telling yourself that the cure for high prices is high prices. In a normal commodity market, when a metal sees a 42% annual price rise, as silver did in 2025, mining executives lose their minds. They rush to dig holes in the ground, they expand operations, and they flood the market with new supply. But that has not happened here. In fact, total global silver supply is forecast to contract by 2% this year. Why? Because of the byproduct trap. Approximately 74% of all the silver pulled from the earth is not mined on purpose. It is a byproduct. It is the accidental secondary metal you find when you are digging for copper, lead, and zinc. Those massive industrial base metal mines do not care if silver goes to $100 an ounce. If the global economy is slowing down and the economics of copper do not justify building a new multi-billion-dollar facility, they are not going to build it just to get the leftover silver. We are trapped in a structural cage where the supply of the metal is entirely divorced from its price. You are essentially waiting for a lumberjack to chop down more forests just because the price of sawdust went up. It is not going to happen. If you want absolute confirmation that the producers know exactly how dire the supply cliff is, look at their actions, not their press releases. Fresnillo, the single largest primary silver producing company on Earth, formally cut its 2026 production guidance down to a range of 42 to 46.5 million ounces. That is a reduction of up to 4.5 million ounces from a single entity. But the move that truly exposes the panic behind the curtain came from BHP, the largest mining company in the world. They just executed a massive streaming agreement, trading their future silver byproduct rights from a mine in Peru for $4.3 billion in upfront cash. Think deeply about the corporate psychology behind that move. A $4 billion streaming deal is a glaring distress signal. It tells you that the producer values immediate dollar liquidity today far more than they value the optionality of holding physical silver into the greatest supply deficit in modern history. They are sacrificing their future to ensure they survive the present. And no one is coming to the rescue. The development pipeline for new silver mines averages 7 to 15 years from the initial discovery to commercial production. The cavalry is not coming. While the producers are selling out the future, the physical vaults that supposedly back the global paper trading system are quietly collapsing. The cable desks severely underreported this, but the Silver Institute has now formalized the data. In the autumn of 2025, the available, unencumbered free float of physical silver sitting in the London Bullion Market Association vaulting system collapsed to just 17% of the total reported inventories. Understand what that means. London inventories are not one giant swimming pool of available metal. A massive portion of that tonnage is locked away. It belongs to exchange-traded funds, sovereign wealth funds, and private wealth custody. It is contractually prohibited from being touched, lent, or delivered. When that free float drops to 17%, the entire global pricing benchmark for silver is suddenly balancing on a pool of metal that is roughly 1/6 the size of what the ledgers claim. This triggered an immediate mechanical panic. 1-month silver lease rates, which historically sit quietly at fractions of a percent, exploded to over 30% annualized in a matter of weeks. A 30-fold spike in the cost to borrow physical metal. This is the exact same underlying mechanics that destroyed the London gold pool in the late 1960s. Back then, central banks tried to manipulate the price of gold through paper agreements, ignoring the drain on physical reserves until the physical reality shattered the paper illusion overnight. We are watching the exact same mathematical arrogance play out today with silver. The October squeeze was not a transient glitch in the matrix, it was the visible surface of a structural collapse. Now, let us turn to the east, where the true physical drain is happening. As I record this, there's a massive story sitting on the wires that tells you everything you need to know about global physical flow. According to reporting dated the 6th of May, Indian banks have been entirely unable to import gold and silver for 5 consecutive weeks. Shipments have been completely paralyzed at customs, snared by supposed administrative bottlenecks and tax rule confusion. I want you to consider the timing of this bureaucratic blockade. This freeze hit exactly as India moved through its most auspicious precious metals buying festival. And it hit as the price of domestic silver exploded to a record 255,000 rupees per kilogram. Just 12 months prior, it was 85,000 rupees. That is a tripling of the domestic price in a single year. And right as the Indian consumer is demanding the metal, right as the Reserve Bank of India enacted a new directive allowing citizens to formally monetize their household silver as bank collateral, the physical import gates are suddenly, conveniently frozen. This is a massive vacuum-sucking supply off the global market, and the administrative delays look less like incompetence and more like a desperate attempt to manage an unmanageable outflow. When physical reality begins to break the system changes the rules. The people running the price discovery casinos know exactly what is coming. On the 13th of January, the Chicago Mercantile Exchange, the dominant force in global commodities trading, formally amended how they calculate margin requirements. They abandoned the traditional fixed dollar framework and shifted to a percentage of notional value. They forced a 9% initial margin on silver, which they later scrambled to cut to inject liquidity after a massive volatility cycle that saw prices crash from over $120 back down to $75 in February. They are rewriting the rulebook because they know the paper leverage is unsustainable. Right now, the exchange coverage ratio of registered physical stocks against open interest sits at roughly 16%. The paper to physical leverage is over 6 times. Historically, any time registered coverage drops below 15%, exchange researchers classify it as stress territory, the exact conditions that breed violent delivery squeezes. They are sitting 1 percentage point away from their own internal panic threshold. The system is recalibrating for a higher equilibrium price because the old model is broken. The final fracture, the one that connects all the others, is the convergence of forecasts that have finally broken away from reality. For the first time in modern Wall Street history, we are seeing a price target range that spans a gap of $174. When Bank of America projects a silver price between $135 and $390 per ounce, They are no longer using a traditional commodity model. They are using the mathematics of a system that has lost its anchor. Citigroup is looking at $150. Macro strategists are on record at $375. Even the most conservative desks at JP Morgan have been forced to adjust their targets upward to over $81 just to stay within sight of the tape. But there is one more lever, a coiled spring, that the market has yet to fully price. In mid-July of 2026, a 180-day window expires for the United States executive branch to decide on a price floor for critical minerals. This is the policy architecture for explicit dollar price intervention. If the government decides to impose a state-mandated minimum price on imported silver, it will not matter where the global spot price trades. The floor becomes the law of the land for refiners and end users. Combined with a Federal Reserve chair who is openly committed to lower interest rates, the stage is set for a state-sponsored revaluation. Now, I promised you the bearish counter-argument because this desk runs on data, not hope. You must look at the $2,570,000,000 that exited silver exchange-traded funds this year. You have to consider that while the 762 million ounce deficit is staggering, independent estimates suggest there are still over 4 billion ounces of silver held in jewelry, silverware, and private reserves that could, theoretically, flood the market if the price hits a high enough fever pitch. You have to look at the manufacturers who are actively engineering silver out of their solar cells to save on costs. The bear case is documented, and it is real. But here is the cold, philosophical truth that the mainstream media refuses to acknowledge. You cannot build a high-tech, electrified future on a paper promise. You cannot fix a physical supply collapse with a ledger entry. The era of reduced stocks is not a headline. It is a mathematical destination. The fractures are no longer hidden behind the curtain. They are appearing on the surface of the exchange, in the vaults of London, and in the customs houses of India. The only question left is whether you will wait for the system to stop breathing before you decide to move. If this analysis has changed how you see the reality of the silver market, make sure to subscribe and leave a comment below with your perspective on the data. The information is out there. Your job is to read it. Invest with logic, never with noise. I am out.